Hey everyone. Today the Stanford Blockchain Club is proud to host Gabe Frank, who's the founder and CEO of Arcade.xyz. So Arcade.xyz is basically an NFT lending platform. I'll let Gabe sort of introduce it in more detail. But Gabe, would love to just sort of hear a bit more about you, your origin story, as it were, how you got into crypto, and maybe how you thought of starting Arcade.
Yeah, thanks, Jeremy. Really good to be here talking to you guys. I started my professional career in crypto in 2017. I was working at a startup in Palo Alto called BitGo. They're a custodian in the space, so they hold crypto, Bitcoin, Ethereum for hedge funds and venture funds, and we provided wallet infrastructure also for like exchanges, fintechs, banks that were getting into the space and needed sort of institutional grade infrastructure as well as custody. That was in 2017. I was there for 2 years, pretty much got an entire lay of the land. So I got to meet a lot of people early on in the industry and sort of build relationships with them and really understand and know the inner workings of the space, for starting at custody at the base level and then getting into lending, getting into derivatives, and kind of meeting the entire space. So it was really cool there. That was under CEO was Mike Belshi, who was, I think, one of the early team members on Google Chrome he worked on, had a really esteemed background in tech in the Bay Area. That company was eventually acquired. I think they're still going through an acquisition by Galaxy Digital. It's a public company in Canada. I think they might have done a SPAC in the US, but towards the end of my 2 years at BitGo, we also built up a lending book. So we were lending out deposits into the custodian to market makers and OTC desks in the space. So basically like a bank. So we were, trying to get custody and assets into the custodian. And then we were trying to lend those assets out and share the interest back with the depositors. So similar to a bank. We hired a guy named Nick Carmi from Wall Street, a Wall Street firm called Tower Research Capital, to sort of build out BitGo's prime services, like prime brokerage. So we started lending out and built up that book to about 150 million. I was part of that team. And shortly thereafter, my former boss at BitGo had started as the chief operating officer at a different startup called Curve, based out of Israel, who was, I think, had just raised an A round when I joined them. I was there for 8 months as sort of the director of sales for Americas and APAC. And they actually developed the first institutional grade MetaMask product working with Consensus. So if you're familiar with MetaMask, it was a multi-signature MetaMask. Well, they used MPC, multi-party computation, rather than multi-sig. It was the first time institutions and fintechs and DeFi funds were able to have sort of segregated Ethereum wallets to interact in DeFi. And that was summer in 2020, and I had been starting to collect NFTs then and trade them, building up a portfolio of assets that I thought was really cool because you could own an artwork online. It was a scarce digital asset. And so the idea really took off to me, specifically because my background before crypto was actually in pawn shops, so pawn lending. So my dad and family had a business of pawn shops in Texas, where we lent against non-fungible physical assets, so jewelry, diamonds, watches. We made loans on those assets, and if the borrower didn't come back and pay them back, then we could sell those assets and recoup our principal, basically. So there was an infrastructure gap in Web3 that didn't allow NFTs to be able to get liquidity from them. So in DeFi, there's billions of assets locked in these protocols and smart contracts, but because there was a sort of new asset class being developed, NFTs, and billions of dollars being captured by this new technology, it was kind of obvious that it would be a new capital market and credit markets would form around these NFT assets. So I decided to spec out first I partnered with my co-founder, who was actually one of my clients at BitGo. At the time, he was part of a private equity fund, also had a mining operation. I had stayed in touch with him ever since BitGo, the first startup. And I knew how he worked and how his personality, and I thought he'd be a good fit for a co-founder. So we spoke about NFTs back then and decided to sort of work together and partner up and build this, create this spec doc of what would become Arcade. And the original idea was, it's a peer-to-peer marketplace for NFT-backed loans. So somebody can sign on to the site with their MetaMask or their Web3 wallet, select the collateral, the NFTs that they want to get a loan against, and then a lender on the other side can fund that loan. And when the loan is funded, the NFTs get locked up into our escrow contract. So the protocol is completely non-custodial. We don't take possession of the NFTs and we don't have control of the money movement. It's all governed by.
So say if I own a proof pass and I want to sort of get an NFT loan bit on that, you guys you might have sort of authorization to sort of take possession of it, but it would still be within my custody throughout that kind of that time, and I can still have access to the Discord or get access to the airdrops and things like that.
Yeah, so that's actually an interesting question because so we've done a loan on a proof pass, but right now that user would lose access to the Discord, right? So the challenge now is becoming how to get liquidity on an asset like that, but also maintain its utility. So getting access to Discords or airdrops, things like that. In our version 2 of the protocol, we're working on ways so that the user can maintain utility, so get access to these channels, but also get liquidity. So today the asset sits in escrow. So the proof pass would be sitting in the protocol. And at that point, it's owned by the protocol. You have a claim note to that asset. When you pay off the loan, you can claim it back. But yeah, today assets inside the escrow contract lose their utility.
And so right now, if I'm sort of, say I hold a Bored Ape or something and, I want to get a loan for that, what's the kind of the step-by-step process on that? And, what kind of interest rate would I be paying or, and things like that?
Yeah. So Bored Apes are one of the most liquid collections. I think it's punks and Bored Apes are what most of the lenders have appetite for today. But basically, if you have a MetaMask or a ledger connected to a MetaMask and you have a Bored Ape in the wallet, you can connect to app.arcade.xyz and you can select that asset to be wrapped in our protocol. So we create a new NFT, we'll call it WNFT, allows users to stick multiple NFTs inside that WNFT to get a loan on a bundle or a basket of assets. So you would go and you would collateralize the asset. You would select what terms you're looking for. So you can select LTV, duration, and the rate. And then a lender in the marketplace can log onto the app and see that request and lend at those terms or make a counteroffer. Most of the high value loans we've done though are through our OTC desk. So on top of the protocol, we operate what we call an OTC desk, where we're building relationships with collectors, with DAOs, with hedge funds that have raised capital specifically to put NFTs on their balance sheet for the next 10 years. Really guys and traders that are looking at it more, as capital efficiency than sort of just getting a loan because I need the money, right? It's a little bit different.
Yeah, that absolutely makes sense. So if you're kind of cross margining and, putting a portfolio together to lend off of, that's presumably going to have lower interest rates and things like that, due to just you're getting rid of some of that, risk essentially. Yeah,
there's some diversification.
If these are uncorrelated assets, if you're putting in a Bored Ape and a Punk and a Proof Pass.
Yeah, I mean, I think lenders have diversification there, but it still comes down to the loan to value ratio. So if we, because part of our company, we basically transformed ourselves into a data company. So we have a data engineering team and a data science team that spits out valuations and appraisals on a lot of this, on these long tail assets. So we would go and we would appraise all the assets in that bundle or basket, present that to both counterparties, lender and borrower. And then that's how terms are worked out. So it's just based on the LTV, really. I think lenders have the appetite mostly for the long tail sort of blue chip NFTs, punks and basic Bored Apes. But yeah, it all depends on the loan to value ratio and what we appraise the assets at.
And so kind of double clicking on that, the appraisal side. So are you guys doing this through just looking at the floor price, or are you sort of incorporating some of the rarity scores? Are you looking at sort of TWAP, stripping out wash sales? I guess what kind of pricing oracle are you using? Is it a proprietary one or,
Yeah, that's a good question. So
Chain link.
Yeah. So there's not a lot there's a ton of projects out there that are kind of doing rarity scores and floor prices and things like that. So we don't base our appraisals and valuations off floor price. It's our own in-house model that we use. It's a combination of a TWAP and some other things that we do. But basically the appraisal is not financial advice. It's just kind of an idea for the counterparties to then come to terms. So there's no like one best way to do it right now. There's protocols like Upshot and other projects like WAGMI and Icy Tools. But most of the projects today, specifically the peer-to-pool projects, where we're peer-to-peer, but there are peer-to-pool projects that use an Oracle price and then can have a mark-to-market price for liquidations. But yeah, we have our own in-house sort of data science team to do that.
So who are the typical users right now that are kind of seeking NFT loans? So like both the people who are actually like putting up their NFTs for loans and who's actually like on the lending side?
Yeah, so on the lending side, it's a mix. It's a mix of institutions. So guys like Genesis, the OTC desk, have made loans on our platform. Nexo recently funded a 1,200 ETH loan against 2 crypto zombie punks. They're a big retail lender in the space. And then it's also DAOs. So DAOs like Flamingo DAO, Neon DAO that, have millions in their treasury that they're looking to get yield on. So that's a good opportunity for them to just put their capital work. Also, it's high net worth individuals that have tons of crypto that have the risk appetite and don't mind in the event of a default, they have to pick up the assets. So it makes sense for them to lend out the funds. Yeah.
And, for say like groups like, Flamingo or, Muse DAO or, any of these sort of NFT sort of, collectors, this seems like quite a manual process still, right? So they actually have to kind of log onto the platform and see, like at any, one point in time, what NFTs are, what sort of, offers there are on the market. Is there a way to kind of, programmatize this, so that like at scale, if you had sort of $10 million like locked up in like USDC or something, you could just actively have that lending out, like, based on specific kind of risk parameters and collections?
Yeah, definitely. I mean, we're working on APIs to the protocol. We also work with a DAO called MetaStreet, who formed specifically to become like the Fannie Mae of NFT loans. And so they're setting it up programmatically via smart contracts to lend directly from their smart contract to our protocol. Yeah, so it'll be a mix of both. It'll be sort of manual, like this OTC style, but then it'll also be the marketplace will bootstrap because we'll have more data inside the DApp. And then these DAOs will be connected via smart contracts. So yeah, it's kind of both ways.
Nice. And what is the typical LTV on, an NFT? What are people taking out loans at?
Yeah, typical LTV is it differentiates based on collection, right? And how liquid the collection is. So punks and apes probably have the highest LTV, up to 60%, I would say. Some of the one-on-one art stuff is a lot lower, so like 20, 30%. So in that range, 20 up to 60%, depending on the collection.
And are you seeing like what sort of interest rates are you seeing across these? And I know they probably vary a little bit, but yeah, assuming it's like a blue chip collection like Bored Apes and punks.
Yeah, our average loan right now is 20% APR and a 3-month term. So they're term loans, non-recourse term loans, lump sum payment at the end. So if somebody gets a 100 ETH loan for 3 months at 20% APR, then for 3 months they're paying 5%, right? And in 3 months they have to pay back the principal plus the 5%.
And were you actually doing any analytics on what some of these folks are using like this for? Are they like doubling down and, are they using this as like a way to kind of take a leveraged bet on the original collection, like the Bored Apes, or are they doing other stuff with it?
Yeah, it's 3 use cases right now. I think it's opportunistic plays in DeFi. So if they want to, lever up and buy ETH or make a trade, then they can take liquidity from an asset that's just sitting there and use it more efficiently. The second one is arbing rates in DeFi. So get a loan for 20% APR and then farm on looks rare for 50% APY. The third sort of group is users that are just wanting to buy more NFTs and simply getting a loan so that they can, buy another NFT.
Interesting. And what's do you guys have is there an insurance mechanism? Say if I'm, putting up my Bored Ape and I'm really attached to it, and I'm kind of worried about that liquidation risk. What's that kind of like, what does that window look like? I know JPEG, for example, they have something where you pay like a 1% extra fee, and you have like this window in time to be able to kind of like reclaim that asset. Like, how does that look?
Yeah, so there's no liquidation mechanism on Arcade. If a borrower doesn't come back, then the lender simply just has to claim the collateral out of the escrow contract. But if they don't, then the borrower can pay off at any time. So we don't have any sort of insurance right now in the protocol. It's something we're looking at, like with Nexus Mutual and some of these other protocols. But yeah, it's interesting that JPEG has that. I think, I don't see any really high value long tail holders sticking their Grail assets into a pool protocol right now, and it's sort of just an experiment. And that's why we're bullish on the P2P space. It's just a lot more flexible, and we can cover the long tail assets. Whereas like pools like JPEG, I think it's going to work, but they're just doing loans on punks right now, and it's mostly based on floor price.
So actually, just taking a step back and stuff, what's some of the if we look beyond like Bored Apes and CryptoPunks, what are some of the next kind of wave of NFTs, maybe beyond PFP projects that you're excited about?
Yeah, right now it's PFP, it's art, it's gaming assets, it's digital land. I think we'll start to get into like more financial assets. So like digital land that's cash yielding, has maybe a museum gallery on it. There's gaming assets that are going to be rented out and generate the yield. And so the lending profile on those more financial assets looks a lot different. But right now there's about 15 to 20 billion, I would say, of lendable NFTs in the market. Whereas the total market cap of NFTs is around 50 billion. Of that, the lendable assets are around 20 billion. So yeah, it just depends on also lender demand. Like what are lenders willing to risk their capital on? Yeah.
Interesting. Well, I'd love to open this up to the audience. If anyone else has some questions, feel free to raise your hand. Otherwise, Gabe and I will keep going here. But just feel free to raise your hand and come off mute.
Yeah. Thanks, Gabe. I just had one question based on what you just said. Was curious what assets or qualities make something lendable in your eyes or in your protocol's eyes as opposed to non-lendable NFTs?
Yeah, I mean, the simple answer there is just speaking to our lenders what their criteria is for lending against an asset. Mostly it comes down to liquidity of the collection. So BASI and Punks have at least some liquidity. There's secondary transactions happening quite a bit. So in the event of a borrower defaulted, a lender could sell the asset in the market and get their recoup their money. But so we look at volume, we look at secondary transactions, we look at amount of holders, we look at community, and then just based on borrower and lender demand.
Cool. Yeah, do you want to come off mute?
Yeah, I had a question around fractionalization. So the NFT fractionalization market, based on what I see, hasn't seemed to have gone in a very sort of solid direction. What I'm wondering is there an intersect between fractionalization and lending on the NFT side?
Yeah, it's an interesting question. I think we've had ideas around like fractionalizing an NFT in the event of a default, where there's a pool of resting, like in a peer-to-pool model. The challenge is what happens in the event of a default, where you have all these capital providers and they have to get their money back in a default. So we've thought about fractionalizing or sending it to one of the fractional projects and recouping liquidity that way. But my main opinion on fractionalization is that it's definitely a security. Like when you fractionalize an asset, you're securitizing the asset. And I think we've seen a few comments from the regulatory bodies that have said something to that effect. So we're staying away from fractionalization right now, but it's something that we're looking at.
Thank you.
And on that front, what do you think of, I know like I was having a chat with, Scott Gray from Genie.xyz the other day. We did an event with him and he was talking about how fractional.art have switched to basically fractionalizing, using like ERC 55s instead of ERC 20s. Is there a kind of way of maybe skirting some of the regulation? Just curious, like if you think that like adds any clarity to any of this or?
Yeah, I don't think so. I think ERC 1155 is interesting though, because they're fungible. They're fungible tokens because you can have one NFT with multiple editions. I don't know how that affects the regulatory side, but yeah, starting, we don't see too many 1155s in the market, especially lendable assets. But I think that's going to change when you have gaming assets where you have like in-game swords, up to several editions and things like that. So yeah.
So a lot of these gaming assets are probably going to be on, alternative L1s and L2s and, like purpose-built chains. How does that affect, your guys' ability to sort of have access to those assets, value those assets, et cetera?
Yeah, I mean, I agree with that. I think the smaller value, lower value stuff will happen on different chains and L2s. Right now, we just support Ethereum mainnet. And that's why our sort of niche is that long tail kind of blue chip market, high value, low volume. I think in the future, that's going to change quite a bit where you'll have lower value loans, but because gas costs are so high on mainnet, it just doesn't make sense to get a loan, say for 1 ETH, right? Yeah. So our average loan size has been around 300,000. But when gaming assets start to come up and there's actually games that people want to play, whatever chains they go on, we'll try and support.
Cool. Yeah, that makes sense. And what sort of volume are you guys doing right now?
We've done 25 million in loan volume since inception. Yeah. So right now, yeah.
Sorry, go.
Yeah, right now, out of loans on the street that we have are locked in the protocol, it's about 30 million in aggregated NFT value inside our escrow contract.
And where do you, we didn't actually sort of like mention music NFTs. Like, how do they sort of fall into this category? Because these are things that potentially have, future sort of like streaming rights, et cetera, so they could be income producing. I know like Royal has done a bunch of drops. Sound.xyz has done a bunch of drops. Are they going to start sort of featuring on this platform?
I think we'll start to see music NFTs. We haven't done one yet. I'm still struggling to understand where music NFTs fit in and how they benefit the sort of creator. But I think we're now starting to see NFTs that have royalties built into them, where each subsequent sale of that NFT, a royalty goes back to the creator. Yeah, so we haven't seen any music NFTs, but I think that'll change in the future too.
Yeah. Hey Nat, do you want to come off mute?
Hey, can you guys hear me?
Yep.
Awesome. Sorry, yeah, I'm driving. Thanks so much. This is incredibly interesting and just great to hear about protocols like this coming on the market. I'm curious, and I hopped in late, so I might have missed it. I'm curious how you think about liquidation, and particularly around, like, if I were to lend, like lock up an NFT and borrow, how would I be reminded or be notified and make sure that I'm tracking when that loan is due and when my NFT would be basically taken if I don't pay it back? Or are there ways to kind of set up more automated repayment of the loan if I have ETH balance in my account? And just how are you thinking about those questions?
Yeah, that's a great question. Right now, there's no on-chain messaging. I think there's protocols that are working on that, but we've set up email notifications for users that want to opt into that. And the normal sort of DeFi way is just to log back onto the app and see if you have any offers, or if your loan went through, or when a loan is due. So we have a front end, we have a UI that users can go and sign into and see all the details of their loans. But other than that, there's nothing really yet. I think once these on-chain messaging apps and notifications get more popular, then we'll start to use that. But the way the protocol is built, it's peer-to-peer, and most of the loans are 90-day duration. So users kind of know, like, hey, my loan's coming due, or I just posted this loan. Let me log on to sign in back on the app and see if there's any activity happening. So that's kind of the normal DeFi way. Just one-click sign on and go look at all your sort of transactions.
And just one follow-up on that, just to understand, and the actual loan protocols on chain. So in theory, other clients could connect to it, or is there some element of your loan status that is mainly just living in a Web2 like Postgres database or something?
Yeah, it's all on chain. So the smart contracts we built, we released them on mainnet, and they're there forever now, right? So when an asset's part of a loan, it's locked into our protocol. Nobody has access to that escrow contract, but the owner of the collateral. So the bar doesn't come back, then the lender has an on-chain claim to that collateral and can unwrap the assets.
Got it. So in theory, also other clients could kind of
Yeah.
pull that in and show that.
Yeah, exactly. So it's all open source, so anybody can use our protocol. Another project could fork our smart contracts and build their own front end. It would be very hard to do that, all the work that goes into building a Web3 protocol, but essentially somebody could just use our smart contracts themselves.
Yeah, I'm more thinking of just like, let's say I lock an asset in your contract, and OpenSea wants to show me like a notification that it's locked. But that all sounds awesome. Thank you.
Gabe, as an extension to that, actually, what are some of the other kind of primitives you think folks could build off using some of the work you've already done?
Yeah, I mean, we're building APIs for the protocol, and the groups that we're talking with, they're like algo traders that are market making NFTs. That's one group. There's also projects like Squiggle DAO and some of these other DAOs that want to automate their own lending. So they want to lend against, like Squiggle DAO wants to lend against Squiggle assets. So maybe they want to have a front end or a UI where users can sign in on their front end, but use our protocol in the back end to get a loan, and they just fund the loans. Other types of products I think will happen are like perpetuals on NFTs. So the ability to go short a collection or go long a collection, as well as, let's see, any other sort of derivative contract that exists in normal markets, I think will happen in NFTs as well. Actually,
that sort of segues nicely into a question we just got in the chat, basically about shorting NFT collections. So Dominic's question is there a liquid market for wrapped NFTs, and if so, could that be used to effectively short an NFT collection? So I guess like on the first point, like, are there any plans to create sort of liquid markets for wrapped NFTs?
Yeah. So because the W, well, it's not the W NFTs that can be used because they're locked in escrow. They're part of loan. There's no like rehypothecating collateral because it's all on chain. It's all over collateralized. But you can do something with the loan notes themselves. So if you're a lender on a loan and it gets funded, then you actually receive a loan note that's also an NFT. And so you can think of, if we have thousands of loans on the protocol, you can start tranching those loan notes into different classes and kind of base the risk off those classes. Or simply, if you're a lender and you want to offload your exposure, you can sell the note, and then that new note holder basically has access to the collateral and the loan.
And are there sort of loose plans to potentially tackle this at some point?
So we don't want to do anything with the notes right now, because the notes are, if you sell a note or if you tranche a note, you're securitizing that asset. So we're sort of staying away from that right now, but yeah, anybody could sell a note on their own if they wanted to right now.
Cool. Actually, on that kind of front with perpetuals and stuff, what are some of the, I guess, like, who are some of the players that are coming in and talking to you about that? Are these sort of like quite large institutions that are like trying to do this on quite a large scale, or are these just sort of one-off sort of like crypto whales?
Well, I'm sure there are. Like, you have Kraken, the exchange that just announced an NFT marketplace, so you can imagine that they're going to build some sort of financial primitive in there, as well as Nexo. What's interesting about Nexo is that when they fund a loan, they have a backstop bid. So there's a third-party guarantor. So if they lend, like they just lent 1,200 ETH against 2 zombie punks, they're working with a group where they can hedge that basically guarantees they get the principal back, because they'll buy the collateral in the event of a default. Because basically a loan is like a put option. A borrower can, you know, if the collateral value goes down, VAR doesn't have to pick it up. He basically bought a put option.
Yeah. Patrick, do you want to come off mute?
Yeah, thank you, and thank you for being here, Gabe. I came late as well, so you may have covered some of this, but I'm curious how you're thinking about the path forward. In one version, there's an opportunity to start building credit history, credit worthiness data, and then making loans on that rather than collateralized. In another version, it's about, I don't want to know your identity, it's more about the assets, and it's always going to be about the asset. How do you think about that trade-off and whether you'll be tracking that sort of data?
Yeah, great question. Right now, there's no on-chain creditworthiness or on-chain identity. Really, it's very easy to get around that stuff. Because we're building in Web3 and this is DeFi, it's kind of a gray area for a lot. Like a lot of the devs on our team have different opinions about this stuff. The loans are just based off the collateral, like you said. So lenders are underwriting the collateral, they're not underwriting the borrower. That's really all that matters right now. But I do see a world where on-chain identity and credit score it does become sort of mainstream. But the reason we're not focusing on that today is mainly because when you get into credit scoring and underwriting based on a consumer and a person, there's all these different regulations and rules that you have to put in place to actually take in that data. So right now we're not looking at that, but I think it will become more relevant as more people come into Web3 and regulations come down.
Yeah, great, thank you.
Yours.
Yeah, thanks. That was one of my questions. So appreciate you covering how you guys think about KYC. I was curious, as you think about going forward, how are you guys thinking about customer acquisition, both on the lending side, but also on the borrowing side?
Sure. One quick point on KYC, because I think that's a different topic. So there's no KYC in DeFi today. Anybody can just create a new wallet and use that wallet and sign in. That's one of the challenges because there's no regulatory clarity. It's like, what's the best practices to do here? You kind of have to do it your own way. So we use a service called TRM. That's a KYT, know your transaction. They basically scrub any wallet that comes onto the platform, see if it's been on a blacklist or OFAC or what have you. And that's what protects the platform. That's what we can do now. I think we do see a world where there is KYC DeFi, but it's not really happening yet. So just wanted to mention that. But to your question on, I'm sorry, could you repeat the question?
Yeah, customer or I guess user acquisition, both on the lending side and the borrowing side.
Yeah, so that's where this OTC desk comes into play. So we have a small BD team that works with collectors in the space. We're on all these different whale chats. We have a Discord and Twitter and different channels that we can reach out to people. I do a lot of PR activity. So, I've talked to a number of outlets just trying to get the word out. Most of the PR and kind of mainstream media is not so good for customer acquisition, but it is good for raising capital and for hiring, just being your name out there in the market. In terms of customer acquisition, it's right now because the P2P protocol is very manual. It doesn't scale very well, but what we're doing is we're building relationships with all these high value collectors and sort of building a trusted team and a trusted name in the space kind of by doing that. So that's kind of how.
Mo, do you want to answer your question?
Thanks, and thanks, Gabe. My question is about the regulation. So I noticed that you're saying that there's certain things you're not interested in moving into at the moment because of the regulatory implications. So be it fractionalization or some other aspects. So at the moment, from a regulatory perspective, are you licensed as a money transfer business, or are there any regulations, or are you in kind of a gray area because you're purely crypto native?
So it is a gray area. There is a bit of regulatory arbitrage happening right now in the entire space. we work with a law firm, Morrison Forrester MoFo, and basically because we design the protocol in such a way where we don't control any of the money movement, it's all governed by the smart contracts. We don't need MTLs for that. Because we aren't handling fiat either, we're just handling crypto. So a lot of that is out of our reach, and yeah. So basically, we don't need money transmission license for what we do today.
Okay, thanks.
Roy, I noticed you put a question in the chat. Do you want to come off mute and ask that? Or I can as well. So Roy is asking, basically, are you planning to open up to sort of, you know, all ERC 721 collections, or are you going to just sort of stick to this, like, I guess, core group that you've individually vetted?
Yeah, I think for the foreseeable future, until we have more of like this decentralized governance mechanism, that we will curate the platform just based on lender and borrower demand and stick to the higher value assets, mainly because if you support every single NFT asset, you're going to start to see loans that the asset doesn't have any value, but they're sort of just wash trading, or, then you run the risk of really money laundering on your platform. So we try and verify that all the collections are liquid and they have a sufficient community behind them and they have a bit of staying power. So we do curate the platform today. And I think that will always be the case, even when we do have more decentralized governance and voting on which collections to approve or not.
And Nat, I saw you raise your hand a couple of times to get down. Is there anything you want to ask?
I have plenty of questions about all this. On the question that the curation layer is, what
Matt, your audio
what
is
would
breaking
you
up a little bit.
suggest? Oh, okay, never mind. I'll put it in the chat.
Okay. All I heard was curation layer.
Just kidding. Oh, I was just gonna say what level, like let's just say that you actually did, choose what collections come on the platform by just your own personal decision. What would you look at beyond just community and volume and things like that? And how would you measure it on chain or off chain?
Yeah, my simple
score heuristic. Sorry, go ahead.
Yeah, my simple answer would just be talking to our lenders and asking them what they would lend on or against. And I think it also comes down to data in the market right now. If they had more access to data and could figure out exactly what's a more lendable asset, because they're really just looking at punks and apes right now. Also like Fuocious and Beeple and CloneX and some of these other ones. But if we were to give them data on new collections that were actually liquid and they had sufficient volume, then they might be open to lending on more assets. So maybe that signal isn't the greatest one, but I guess in my opinion, it would be the team behind the project, who's building it, who the creator is, the collective demand for the project. Do they have a presence on social media? Do they have a Discord? How many secondary transactions are happening on which marketplaces? So things like that we all look at and take into account.
Got it. Yeah, sounds similar to evaluating an NFT collection to buy. Obviously,
yeah.
How liquid is it? Basically, is the question.
Yeah, it's pretty much the same signals I would use to buy an asset.
And Gabe, on that note, actually, how active are you in just kind of like, trading your personal account and investing in NFTs and collecting?
So I make very few plays, but when I do, I go pretty hard. And I don't have really time to be so involved in Twitter and be, join all these Discord groups and Telegram groups. So I miss a lot of the alpha on like what to buy today. The last collection I bought was Moonbirds, so Kevin Rose's proof collection. Before that, it was Bored Apes. So yeah, I just try and find the really good projects that I think have staying power and have founders that will keep pushing out value for their users.
So Moonbirds is a pretty good example of something that I assume probably would, if it's not on your platform already, it probably would fit the category of being able to be just like, blue chip, strong team, loads of secondary volume. At what point I guess, does that become attractive for a lender? You know, like this Moonbird's launched like what, 2 weeks ago now. Like at what point are they starting to look at that, and at what point does that start to look like kind of a blue chip asset that they would lend against?
Yeah, I think it happens slowly, kind of upstream. So it goes like, for example, I lent against a Moonbird last week. So because I know the collection and I have an asset and I'm bullish on the collection, so it makes sense for me as a lender to earn some extra yield on my ETH. For institutions to feel comfortable lending millions of dollars on the assets, it takes a little longer. So they have to see some historical, data on the collection, how it's trending, what the liquidity is, and all that information we try and provide lenders, but it takes some time. If you were to ask me, like, would Genesis lend against a Moonbird today? The answer would be no. Would maybe in 3 months, if there was some history and some data to provide to them, then likely they would.
So is that a role you think Arcade can start playing a bigger part in, basically curating a lot of this stuff, creating that data layer that gives these lenders maybe that early insight into these collections that they might otherwise take a few months to kind of get comfortable with? You can actually kind of give them that data upfront, across all the kind of key parameters that you think are important.
Yeah, 100%. So we actually have, Arcade is our core flagship product. It's the P2P marketplace. We also have the domain metadata.xyz, and that's actually where we're releasing a data product. So we're looking at metadata to be a flywheel for the app, because we're going to put a lot of that data inside the dApp to sort of bootstrap the marketplace. But that data service is also something we can monetize as a SaaS or sort of an NFT subscription as well. And I think that, those two products become a flywheel for each other.
Yeah, absolutely. I hadn't heard of metadata. That sounds really cool. Patrick, do you want to come off?
Yeah. Again, you might have covered this a little bit before I joined, but I'm curious how this works as NFTs get more and more functionality that's not just value. So, for example, whether it's a membership pass or Moonbird's example, you can supposedly nest them and not sell them and earn benefits from that. Is that something that when you wrap them and use them as collateral, you can preserve those functions? Or is that something you have to build into preserving? Or is that ultimately going to mean that you might see less things like Moonbirds and more things that are just art value on the platform?
Yeah, today most of the assets in escrow don't have utility other than number go up and collective demand. I think though we're starting to see much more, and it's going to become much more relevant, is keeping that utility but also getting liquidity on the asset. Specifically, on the proof passes, we've been working with Collab Bot, which is basically the bot that allows people into Discord by crawling your wallet and seeing that you have that access token in your wallet. So we're talking to Collab Bot to basically read a proxy token, which is the loan note that would allow access to the same Discord. There's another example like digital land. Like if you get a loan on a piece of digital land in Decentraland, the asset goes into escrow. Well, when it's in escrow, you can't build on it. So there are ways though to build the protocol to maintain that utility, but also get liquidity on the asset. It just depends because their projects are all different. Another interesting point is like we have a golden board ape that's escrowed in the protocol. Well, the recent ape coin drop, we needed to figure out how we could claim the airdrop, but still keep the asset in escrow. So what we did was pretty interesting. We developed a contract that, so the asset's in escrow, we developed a contract that got a flash loan from Aave, paid off the loan, claimed the ape drop, repaid, claimed the ape drop, reopened the loan, paid back the flash loan, and that's how we did it. So you can do it a couple ways. One is a flash loan, the other is building the contracts just to support the utility of the collection.
Right. So it sounds like you're sort of addressing it, but now it's kind of a case by case, and it might be something you have to look at making more of sort of the core infrastructure going forward.
Yep, exactly.
I know Natalie in the chat also just mentioned she was going to ask a similar thing about the Azuki Beans airdrop as well. I don't know if you've got any comments on that.
I haven't heard of the beans drop yet, but we do have a few Azuki bundles in our escrow right now, so I'll have to check that out. But if depending on how the airdrop works, if it's a claim function, you know, we can get it done on a one-off basis, but that's something we'll build into like our V2 protocol say.
Okay, thank you.
Yeah, you already answered it, but that was basically my question, and I think a simple like safe transfer out method would probably do it for you.
Yeah.
Robe even cooler, as you said, if like the owner of the locked asset could transfer out airdrops for their account, but that's harder because there's no like metadata linkage or anything between the actual airdropped asset and the original asset. So kind of tricky.
Yeah, we are building it's airdrop friendly vaults. Where right now the peer-to-peer protocol, when you escrow it, it's a pooled contract. So all the assets are sitting in one pooled escrow contract. Our V2 protocol will allow segregated vaults basically for each one. So if I deposit an NFT into this segregated vault and I get an airdrop, well, then I can claim that airdrop out of the vault as well. Yeah.
That's awesome. And then the vaults would actually have different effectively contract addresses.
Yes.
Interesting. So if in that scenario, just I'm curious technically, when you deploy, when you lock an asset, does it effectively deploy a new instance of the contract, more or less? Or is it one contract? Does it handle it some other way, basically?
You know, I'd probably answer this one wrong. I'd have to ask someone else on our team. But that's a good question.
Cool. Thanks.
Rajesh?
Yeah, I was wondering, Gabe, from your point of view, what do you think are some unsolved problems in the NFT space today? What's most pressing from a founder's standpoint?
There's a lot. I think one that I think about a lot is the images or videos or the JPEGs being stored on like AWS or projects or like on Nifty Gateway. I don't know if they've changed it, but the image lives on their servers, right? So if they went down, you could lose the image. You still have the token, it's on the blockchain. But I think there's, you know, minting contracts that are working on storing the image in like IPFS or some of these decentralized servers. So that's one I think about. Also, you know, 95% of the NFTs in the market are worthless, probably going to zero. I think it's the 5%, that 20 billion of lendable assets that are going to gobble up most of the value. There's just a lot of cash grabs right now, and it's easy to make a couple $1,000,000 if you know what you're doing. So yeah, and I think, you know, hopefully this, if we're in a bear market, that'll wash out a lot of these, you know, smaller people just trying to get cash grabs. But yeah, I guess those two.
Thank you.
The Dominic had a question in the chat, basically just asking, you know, what are some of the key challenges that, you know, you're facing in building out some of the kind of that data layer? You know, if we focus on like say metadata.xyz.
The key, yeah. So, you know, we have 2 data engineers that are working with a program called Closure, and really right now the market's kind of saturated with projects that are working on NFT data, floor pricing, alpha, whatever. But there's no one brand or one project that has a majority of the market. So I still think there's somebody can become a category leader here. Whereas like you have Nansen, who's more on the DeFi side and cryptocurrencies, they're starting to get into to NFTs. But our distribution on the data product is going to be pretty good because we're already in front of a lot of these users, and because we can offer a lot of data that's free inside the dApp that these other protocols or projects charge for. Because because we have a monetization route that's on the app Arcade, we don't need to monetize some of this data that other projects charge for. So yeah, it's just getting the right distribution out. It's figuring out if this is a SaaS product or if this is, you have to mint an NFT to get a subscription, and how we're going to monetize that. It's kind of interesting because the data product is like a Web2 product, and then Arcade is a Web3 product. And so it's kind of a hybrid of both that will be a flywheel for each other.
And when you're kind of querying that on-chain data, are there any issues kind of getting that, you know, in real time? Is it sort of, you know, costly? Is it, you know, Dominic just had a few questions around that.
Yeah, I mean, a lot of the industry relies on the OpenSea APIs. There tends to be a lot of issues with that. So we're using, we use the OpenSea API to crawl data and assets, but we also use Alchemy. So we're looking at the chain directly. And it's just ingesting that data and then feeding it to a data science team that's able to create outputs with it, charts, floor pricing, valuations and appraisals. Yeah.
So if we kind of just zoom out, like what are some of the things you're really excited about, in the next, I don't know, let's call it like a year or two. I think sometimes like we're so sort of focused on the short term in this space because it's so dynamic and things change so quickly. So it's kind of hard to zoom out. But, if you had to guess, what do you think some of the big areas are going to be in a year from now, 2 years from now?
Yeah, excuse me. I think gaming assets will become a lot more relevant. I think there will be so many competing metaverses. Like you have Yuga Labs, you have, I'm sure Kevin Rose and Proof are going to build their own metaverse. You have Adidas, you have Facebook, but there's no one Schelling point. So I think that we'll start to see more composable sort of metaverses building out where you can transfer assets to different ones. I think that NFTs will bring in the next billion users into Web3 in the next 5 years. I think NFTs will become $1 trillion asset class. And I think a big portion of those NFTs will be used for liquidity and capital efficiency. So from where I sit, when I see $1 trillion asset class in 5 years and a portion of that's going to go towards loans, that's what I'm excited about. Because that's how it works in other, parallel lending markets like trad art. So like Monet's and Picasso's, owners of those artworks, they get loans on that work from guys like Bank of America at much lower rates. But if somebody buys $100 million Picasso, that's a lot of money to be tied up in one asset. So they can get a loan on that asset and invest it elsewhere and beat the rate. So we're going to see a lot more of that. And NFTs capture way more than just the art vertical. And the trad art vertical loan market is about 30 billion today. On an asset class that's like 2 trillion in privately held art. So yeah, I think, it just doesn't just encompass art, it's metaverse, it's gaming assets, it's financial assets. There's so many things that can be captured by an NFT, it's digital IP. So I'm excited about the whole space still, really.
And do you think your sweet spot is going to continue to be on this really kind of high value segment of the market? Like the blue chips, or do you see yourself kind of, really bringing this to the rest of the NFT market at some point?
Yeah, I think for the next 2 years, it's going to be very niche and high value. I think we'll start to see, and we are seeing it, like private equity funds and firms that are buying digital real estate, looking at it like a physical real estate investment, where they're going to build on top of it. It's going to be rentable. That's going to change the profile of these assets quite a bit. But yeah, so then in the next 2 years, I think institutional capital starts coming into NFTs, whether it's via lending or whether it's via putting assets on their balance sheet. Though I think further than that, in 5 years, I think we'll have billions of transactions on a peer-to-peer basis just on Web3 rails. So I think it goes like high-end niche for the next 2 years with more institutional capital coming in. And then once more retail has like Web3 wallets and understands the space a little bit more, interacting with NFTs and different protocols, that's when I think, we'll see the next billion users and it'll become more retail.
And do you have a perspective on, for right now, that there's been, a bit of chatter in terms of basically making a real world asset an NFT, but, it fundamentally has this bridge that you have to trust. And, I don't know if these oracles are ever going to become sort of, what it's just basically not on chain. So you're trusting whatever entity is mapping that thing from on chain to off chain. Do you think there's going to be a world where that, there's a solution to that and you get whatever it is, like, property assets or basically anything that's non-digital that can actually be effectively sort of stored in NFT?
Yes, I do think we'll see that world. That's not something we're going to tackle though, for sure. I think anything off chain, you start dealing with logistics, you start dealing with overhead. I think there's a project called, I think it was like 4k.com or something. They are doing that. So they have a warehouse that has a camera that they can, like, they're doing it with Rolex watches right now. So if you send them a Rolex watch, it goes to their warehouse, it films them like packaging it up, and then they create an NFT and keep the Rolex in that warehouse, and then just create an on-chain asset for it. I'm having a hard time seeing how something like that will take off, just because there is no oracle to say, hey, yes, the Rolex is here for sure, 100%, and so is the NFT. Well, what happens when the two of them, what happens if the Rolex gets burnt or lost or something happens? Then you just have this NFT that becomes valueless. I think there's too many logistical problems and kind of regulatory stuff that I'd rather stay away from today anyways.
Yeah, no, and I think that the digital space is exciting enough to kind of, focus on and make your mark in.
Yeah, definitely. I think the digital economy, like online ownership, is just going to really, it'll be $1 trillion market. So those are the assets we're excited about.
So Gabe, I know we're at time here. Just want to say thank you so much for coming in. I really enjoyed this chat, learned a ton, and I'm sure the audience did as well. If people want to kind of interact a bit more with Arcade, obviously go to Arcade.xyz. And are you guys hiring for any specific roles right now? The Stanford Blockchain Club is full of a bunch of CS students, engineers, economists, biz school folks.
Yeah, for sure. We're always hiring. So we have some JDs up on our site on LinkedIn.